There is something happening in the American economy right now that the headlines cannot seem to locate, and yet 70 million households feel it every single week. They feel it at the grocery store when a package of ground beef that cost $8 3 years ago now rings up at $11. They feel it when the electric bill arrives. And the number on the statement no longer corresponds to the number they budgeted. They feel it when the credit card statement lands in the mailbox and the minimum payment alone has become its own small monthly crisis. The economy, according to every official dashboard, is functioning. The economy, according to the lived experience of the American middle class, is quietly bleeding them out, and the distance between those two realities is not a rounding error. It is the story of 2026. It is the story that big cycles exist to tell. Let us begin with a number that should stop you cold. As of the first quarter of 2026, Americans are carrying $1.252 trillion in credit card debt, not consumer debt broadly, not mortgages, not auto loans, credit cards alone. That is the highest figure the Federal Reserve Bank of New York has ever recorded. Since it began tracking this data in 1999, the average interest rate being charged on those cards right now is 21.5%. Think about what that means for a family carrying the average balance. The interest charges alone are consuming purchasing power that used to go toward savings, toward retirement, toward the kind of financial buffer that separates economic stability from one medical bill away from disaster. In 2024 alone, Americans paid $160 billion in credit card interest, not principal, interest. That is money that disappeared. That is purchasing power that was manufactured, used to maintain a standard of living, and then quietly evaporated into the coffers of financial institutions while the spending it funded showed up in GDP as economic health. This is where the divergence begins. When a household earns $60,000 a year and charges $11,000 to credit cards to cover the gap between what they earn and what everything costs, that spending appears in the national accounts as consumption. GDP goes up. The economy on paper looks fine, but the family is not fine. The family has borrowed against its future to maintain its present. And when that borrowing capacity runs out, and for millions of American households it is running out right now, what happens to the consumption that was holding the official numbers together? That is the question that every confident economic headline is quietly ignoring. The inflation numbers tell us that prices rose 4.2% over the 12 months ending in May 2026. That is the highest reading in 3 years, and it is accelerating, not fading. Energy costs are up 23.5% year over year, driven by the geopolitical shock in the Middle East. Gasoline prices have surged more than 40% in the past year. Shelter costs, the single largest component of most American household budgets, are running 3.4% higher. Medical care services are up 3.6%. Food away from home, which is to say every lunch eaten at a desk, every dinner that was not cooked at home, is rising 3.5% annually. Fresh tomatoes are up 32% year over year. Sugar and sweets up 7%. These are not abstractions. These are the numbers behind the feeling that something is wrong that most Americans cannot quite articulate, but absolutely cannot escape. Now place that against wages. The average American worker has received nominal pay increases over the past 3 years. On paper, incomes are higher. But when you subtract what inflation has taken, when you calculate the purchasing power that those dollars actually command at the checkout counter and the gas pump and the pharmacy, the real wage picture is far less comfortable. You got more dollars. Those dollars buy less. The arithmetic is not complicated, but its implications are profound and they compound year after year. Run that equation across 70 million households for 3 consecutive years, and what you have is not a statistic. What you have is the slow, methodical destruction of the financial margin that working Americans depend on to remain solvent, to remain stable, to remain one disruption away from catastrophe rather than already in it. That destruction has a name in economic history. It is called the slow bleed. If you find this analysis useful, if big cycles is giving you the framework your financial advisor never mentioned and your evening news has never touched, then the most important thing you can do right now costs you nothing. Subscribe, because what comes next in this video is the part that the financial press will not cover until it is far too late to act on. The slow bleed is not a metaphor invented for dramatic effect. It is a term used by economists who have spent decades studying the mechanics of debt cycles, the long arc of how civilizations and economies build up debt, how that debt distorts behavior, and how the distortion eventually becomes unsustainable. The pattern they identify looks almost nothing like what most people imagine when they think of a recession. Most people imagine 2008, the sharp drop in asset prices, the bank failures that appeared on front pages, the moment of visible crisis. The slow bleed looks nothing like that. It is not a crash. It is a compression. The economy continues to grow in aggregate while an increasing share of the population experiences a declining standard of living. The stock market rises because companies have pricing power and can pass their costs to consumers. Those consumers, squeezed between rising prices and stagnant real wages, reach for their credit cards. The credit card balances grow. The interest compounds. The spending continues just long enough to show up as healthy consumption data. And then quietly, the capacity to borrow runs out. Consider what the data is already showing us beneath the headline numbers. 3 out of 5 Americans who carry a credit card balance have now held that balance for at least a year. That is up from 1 out of 2 just 12 months ago. Nearly a third have held that balance for more than 3 years. 1 in 5 people carrying credit card debt says they do not believe they will ever pay it off. Not next year. Not after they get a raise. Never. That is not a data point about individual financial mismanagement. That is a structural portrait of an economy in which the gap between what things cost and what people earn has become permanent for a significant portion of the population, and 33% of people currently carrying credit card debt report that the primary driver of that debt is not a vacation they should not have taken, not a luxury purchase, not a lifestyle choice. The primary driver is day-to-day expenses, groceries, utilities, childcare, the baseline cost of existence in America in 2026, financed on a revolving credit line at 21% interest. This is the mechanism, and the mechanism matters more than the headline, because the mechanism tells you not just where we are, but where we are going. What happens when a critical mass of households exhausts their credit capacity simultaneously? Consumer spending softens, earnings at the companies whose revenues depend on that spending disappoint. And when earnings disappoint in a market that is currently trading at elevated price to earnings multiples, the adjustment in asset prices is not gradual. It is abrupt. It is what happens when everyone realizes simultaneously that the paper wealth reflected in their portfolio statement was built on a foundation that was always more fragile than it appeared. And here is what makes 2026 different from every previous moment when this conversation might have been had. The stock market is not cheap. It is not even close to cheap. The S&P 500 is currently trading at valuations that are higher than they have been approximately 87% of the time over the past 4 decades. The 10 largest companies in the index now account for nearly 39% of its total market value. The earnings growth that Goldman Sachs and other institutions are counting on to justify those valuations is itself heavily concentrated in a handful of technology companies whose revenues are being driven by artificial intelligence. Infrastructure spending, roughly 40% of S&P 500 earnings growth this year, is expected to come from AI-related investment. That is not a broad economic expansion. That is a very narrow concentration of capital in a very specific bet about the future of technology. And when concentrations of capital that narrow have appeared historically, the eventual dispersal has never been orderly. The historical parallel that serious economists keep returning to is not 2008. It is not the dot-com collapse of 2001. The parallel that keeps appearing when you study debt cycles carefully is the 1970s. And the reason the 1970s parallel matters is not because the surface details are identical. They are not. The reason it matters is because the mechanism is the same. In the early 1970s, the official economic numbers showed growth. The stock market had enjoyed years of expansion. Corporate America was profitable. And yet underneath those numbers, the same compression was running. Real wages were being eroded by inflation. Consumers were borrowing to maintain living standards that their earned income could no longer support. The official recession declaration, when it finally arrived, told people something they had already been living for years. What the 1970s also showed us was what happened to different categories of assets during a slow bleed environment. The assets that most Americans hold in their retirement accounts performed terribly. The S&P 500 delivered negative real returns for the entire decade. Bonds, which were supposed to provide the safe half of a balanced portfolio, also delivered negative real returns as inflation outpaced the interest they paid. The assets that preserved and grew wealth during that period were the ones that most retirement portfolios held least of. Gold returned more than 9% annually in real terms across that decade. Commodities broadly outperformed. The assets tied to the real productive capacity of the physical world held value in ways that financial paper did not. The 60-40 portfolio that every financial advisor has recommended for a generation was not designed for that environment. And the environment we are now entering has more in common with the 1970s than with anything the standard retirement planning model was built to handle. Here is the thing about recession declarations that nobody talks about until it is too late. In 2008, the National Bureau of Economic Research officially declared a recession in December of that year. The recession, according to their own subsequent analysis, had actually begun in December of 2007, a full year past. Between the moment the slow bleed became a formal downturn and the moment the declaration was made, by the time the official announcement arrived, markets had already fallen by nearly 40%. The people who were positioned before the declaration did not lose what the people who waited lost, not because they were smarter, because they were paying attention to the mechanism rather than the headline. The crash always arrives after the slow bleed, and the slow bleed, measured not by quarterly GDP figures but by the purchasing power draining from American households over 3 consecutive years, is already running. The question that Big Cycles is built to answer is not whether things will get difficult. The evidence suggests they already are, for tens of millions of American families who are financing their basic cost of living on 21% revolving debt and do not believe they will ever be free of it. The question is what you do with that understanding, how you think about the assets you hold, how you think about the structure of your retirement savings, how you think about the difference between nominal gains that feel like wealth and real purchasing power that actually is wealth. These are not simple questions. They are not questions that have the same answer for every person in every situation, but they are questions that cannot be answered well by people who do not understand the mechanism, and the mechanism is exactly what this channel exists to explain. $1.252 trillion in credit card debt, a 4.2% inflation rate accelerating for the third consecutive month, an S&P 500 trading at valuations higher than 87% of its historical range, and a credit card interest rate of 21.5% compounding against the balances of 111 million Americans who cannot pay their statement in full each month. These numbers do not exist in isolation. They are connected. They are the slow bleed, running exactly as it has run before every major financial dislocation in modern economic history, just quietly enough that the headlines keep calling it a healthy economy right up until the moment they cannot. Tell me in the comments below what this economy actually feels like from where you sit, not the number on your brokerage statement, not the jobs report. What happens when you open the grocery bill, when you fill the tank, when the credit card statement arrives? The most honest answer in the comments, the one that reflects the real lived experience rather than the official narrative, gets featured in the next episode. because in the next episode we go one level deeper into the debt cycle mechanics that connect everything we discussed today, specifically the signal that has appeared before every major downturn in modern history and that is flashing right now, and why almost nobody is talking about it until after the fact. That episode goes out next week. You know what to do. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.